Today, we're digging into Wayfair's fourth quarter earnings report, which turned out to be a real head-scratcher for investors. On the surface, the company actually beat expectations. So why on earth did the stock absolutely plummet? Let's break it down.
At first glance, this looked like a pretty clear win. Wayfair came out and posted results for Q4 that were better than Wall Street was looking for, both on revenue and, more importantly, on their preferred profitability metric, adjusted earnings per share.
But the market just hated it. The response was immediate and pretty brutal. In spite of those positive headlines, the stock took an absolute nosedive, dropping double digits right after the announcement. So that's the real puzzle we're here to solve. What did investors see that spooked them so badly?
And just to show you how bad it was, on February 19, 2026, the stock shed nearly $12 a share. That is not a small move. And it tells you right away that the real story wasn't in those headline beats, but was buried somewhere much deeper in the details and in the company's forecast.
All right, so let's get into the numbers themselves, because this is really where you start to see the two completely different narratives that were going on inside this one earnings report.
Okay, so take a look at this contrast. You can see it right here. A nice beat on revenue, a solid beat on adjusted EPS. Looks great, right? But then your eyes drift down and bam, a big miss on GAAP EPS. They actually lost real money. And then, maybe even more concerning for a so-called growth company, their active customer base actually went down year over year. So yeah, it's complicated.
And this slide just lays out that whole investor dilemma perfectly. The bull case is all about those adjusted numbers, right? Strong adjusted profits, impressive adjusted EBITDA, positive free cash flow. Management is basically shouting from the rooftops, hey, we're gaining share and we're doing it profitably. But then the bear case just points to that big GAAP loss, driven by real things like stock compensation and, of course, that shrinking customer base. It's the classic GAAP versus non-GAAP showdown.
So management knew they had to tell a good story, especially with the consumer being so cautious right now. And on the earnings call, they've really leaned into three big initiatives that they're betting on to drive growth from here.
First up is their paid loyalty program, Wayfair Rewards. You can think of it like an Amazon Prime for furniture. You pay $29 a year, you get 5% back, free shipping, all that good stuff. The whole idea is that for a customer who spends around $600 a year, it pays for itself. But here's the really interesting part. They said more than half of the new people signing up were actually customers who hadn't shopped with them in a while. So it's working to bring people back into the fold.
And we're not talking about some small pilot program here. This thing already has over 1 million members. 1 million members. And get this, those members are now driving more than 15% of all of Wayfair's US sales. So yeah, this is a huge piece of their strategy now.
All right, initiative number 2. They are going all in on physical stores. They saw some success with their first big store outside of Chicago, and now they're just stepping on the gas. We're talking massive, 150,000 square foot locations in places like Atlanta and Denver, plus a smaller one in Columbus. And the pitch from management is that these stores create a halo effect, lifting online sales in the area by almost 30% for things people buy often, like decor and bedding. Okay, and for all you balance sheet watchers out there, this was a big deal. Management made it very clear they're trying to clean things up. They went out and bought back over $100 million of their convertible debt, which is a fancy way of saying they prevented a bunch of new shares from being created down the line. We're talking over 5 million shares. The result? Their net leverage, basically their debt level, is way down from over 6x to under 2.5x. They're trying to tell investors, hey, that old story about our messy balance sheet, that's over. So you've got these growth plans that sound pretty good, a balance sheet that's getting stronger. So what gives? Why the huge stock drop? Well, as it almost always does, it all came down to the guidance, what they said about the future. And that's where the market found its reason to sell. And at first glance, the guidance for the next quarter didn't seem so bad. They're guiding to mid-single-digit growth, that's fine. They're guiding to an adjusted EBITDA margin between 4.5% and 5.5%. Okay, so they're still going to be profitable on an adjusted basis. Nothing here screams sell everything, but the devil is always in the details, isn't it? Or, in this case, in what the CFO said next.
And that's the line. That right there is the quote that killed the stock. The CFO basically told the market, hey, we are willing to let our gross margins slip below 30% so we can go grab market share even faster. And to an investor, especially in this economy, that sounds a lot like a price war. It sounds like promotions, discounts, and a whole lot of pressure on actual profits.
All right, so let's step back and put it all together to see the final verdict from the market, because it was pretty clear. This chart really tells the whole story, doesn't it?
In the month surrounding that earnings report, Wayfair stock just got crushed, down almost 23%. Meanwhile, the rest of the consumer discretionary sector was down just a couple of points, and the S&P 500 was actually up. This wasn't the market pulling everything down. This was a Wayfair problem, plain and simple.
So here's the bottom line, the central conflict for anyone looking at this stock. You have management telling this story of profitable share gains, and they're pointing to their adjusted numbers as proof. But the market is hearing something totally different. They're worried that this growth is just being bought with margin-killing promotions and investments that are going to keep the company from ever making a real, honest-to-goodness GAAP profit.
So where do we go from here? Well, from our view at Talk Tickers, this sets up a very clear prove-it story for the next couple of quarters. Here's exactly what we're going to be looking for.
Okay, we've got a 4-point checklist. Number 1, can they actually hit their Q1 guidance? Just execute. Number 2, what's the ROI on these big bets? Are the new stores and the rewards program actually leading to profitable repeat business? 3, margin discipline. Was that warning about dipping below 30% just a temporary thing to grab share, or is this the start of a dangerous, slippery slope? And finally, the big one. Can they finally close that massive gap between their adjusted profits and their real GAAP losses?
So, putting all of that together, our official rating on Wayfair is market perform. Look, we have to give them credit. They're definitely taking share and they're proving they can generate adjusted profits even in this tough market. But those significant GAAP losses combined with a direct warning that margins are about to come under pressure, that's just too much uncertainty for us to get more positive right now. They really need to prove that these investments have a real payoff.
So what's the trade idea here? When do you get interested in this stock? Well, we think the real signal to get bullish isn't just seeing another adjusted EPS beat. No, the real signal is when you see that gap, that huge chasm between GAAP earnings and non-GAAP earnings, finally start to narrow in a meaningful way. When that convergence happens, it'll be the market's proof that all this spending is creating real, sustainable profit, not just, empty calories. That's the inflection point to watch for.
This is not financial advice.